Hello, this is Rich Patterson. It's April 12th, and this is the Critical Point podcast with an update on the real estate market relative to REITs, an update of the REIT index, and we're actually using the NAREIT index. You can find it at NAREIT.com, and this is how you spell NAREIT's National Association of Real Estate Investment Trust. Now, a few weeks ago, we made a forecast saying that it was due to peak the latest allowed of 2019. This was the model output for a top suggesting 2015 to 2019, and then you would use smaller cycles inside to try to find the actual top. And we felt like this decline into a 3-year cycle bottom might have come from a 9-year cycle top, so we felt like 2016 was a high, and in 2015, 2016 we had a secondary recession, primarily in manufacturing and commodities. Now, we then saw this abrupt reversal high, and we said, okay, we didn't call it. And then late in 2019, with the amount of pumping of money from the Federal Reserve and the amount of enthusiasm of those in the stock market, and the discussion that the rich were taking profits in stocks, putting it in the stock market, even if they were optimistic, meaning the optimists would buy real estate, but also the pessimists nervous over a coming recession, we're also buying real estate, okay? So it was really a frustrating time because we felt like, is it possible we just missed a 9-year cycle top and bottom and the trend is now up into late in the decade? Or is this one last chance for top? Well, look at this. 2019, the high is 229.93. What's the high of 2020, which is outside of our target? And the high was 229.43, created a double top, actually just a little bit lower price, and then it fell apart, okay? So it proved the cycle worked again, all right? And you can argue this is just coincidence because of the exogenous factor of the virus impact and destroying our economy and fear, but the bottom line is it still worked. It still met the requirements. So what are some of the other requirements? Well, one is we wanted to see a sharp turn down and violate the trend of lows since the supercycle low back in 2009 with the Great Recession low, and the market has done it, or at least this index has done just that. Now, in addition, we want to look at the percent of decline, and as of March, it fell by minus 27%. Not as much as the stock market, but the stock market's recovering now. We haven't seen yet whether this index is recovering some. If we go back and look at history of just 9-year cycles, we have a minus 15.9%, we have a minus 36%, and now we have a minus 27%, meaning it's in the historical range for a potential downside objective. Now, if we look at some of the larger declines of like 66.5%, 52.3%, 71%, these were all connected to larger cycles of 18 years on up to 72 years. Those were super cycles. We're not due for a super cycle bear market, or at least I should say this index is not, and real estate is not, and neither is the stock market, or the economy for that matter. Even though I realize short-term data in the stock market right now is hinting at a depression, we want to wait a year or more to see long-term data to see if it truly adds up to a depression, and the model is currently saying we're not going to have a depression. And the Fed is pumping even more than ever and basically said there's no limit to its pumping, okay? And the Treasury is now involved and the government's now involved. So at any rate, what would be some of the other potential downside objectives? Well, for the technical folks, you can draw a trend line across supercycle highs, extend it out. You really, at first glance, it doesn't look like they paid any attention to that trend line, but then look in greater detail. We do see 2005 open down to near that trend line and then soared. We can see it hesitated in 2011 and respected it and went above it, came down below, and even finished the year below it. However, next year gapped above it. That's actually a sign of a respect. So this trend line may be of some value here this year into next year of somewhere as a low in the 150s. This gap zone would suggest 140s to maybe upper 130s. Now, how about time objectives? Well, this horizontal black bar is the amount of time that the model is suggesting it will take for a bottom. And it's saying we should see a bottom no later than 2021 for this index, and it may occur this year. What will occur once we find a bottom? Well, we should see this index rebound into the years of 2026 to 2030. In theory, this index can top a little earlier than the U.S. stock market and economy. Why would we think it can fully recover? Well, the top was a 9-year cycle only. It was just a major long-term top, but it violated a supercycle top. So the model is supercycle bullish, real estate relative REITs, and we already know that it put in a 72-year cycle low, in fact. And so the odds favor a record high coming, but we don't know how high, and there's no guarantee it does it for this particular 9-year cycle into the top late this decade. It could delay a record high for a considerable amount of time. And there is some discussion that this virus impact on our economy and the way we think and behave is going to impact the consumer. Could it impact how we buy real estate? And is that a negative or is that a positive? More to come. I'm Rich Posson. Thank you. And as I've stated, perhaps only by coincidence and luck, the model was proven correct again for this major long-term bear market. Now we have to find a low. Thank you. As always, manage your risk relative to the analysis of others and your own.